Hello everyone, today we are going to run the optimal capital structure. What is capital structure? The capital structure means the mix of debt and common equity with which the firm intends to raise capital. So in the balance sheet, the left hand side is total asset and right hand side is total debt and total equity, right? So we want to find especially debt proportion because debt have priority, right? Because when firm generates profit, they should pay back their interest and face value to debt holder, right? It has more priority. And equity holder, so we can say the residual frame holder. So optimal capital structure is where the P0 is maximized. P0 means what? The stock price, right? So at the first class we want objective of firm, right? What is objective of firm? Maximizing firm value, and firm value can be measured by stock price, right? So we can also say maximizing stock price. So now you want to find like this graph. The x-axis is debt ratio, y-axis is firm value. So optimal capital structure is about where our firm value is maximized. This slide shows the sequence of events in a recapitalization. Recapitalization means the process of the change capital structure. So for example, if the firm's debt ratio changed from 0 to 20%, we can interpret this as company issue bonds and use the money to buy back the stock. So there are three steps. The first one is firm announce recapitalization, and second, new debt issued, and then firm gets some money, right? The money is proceeds. The proceeds are used to repurchase the stock. How much to repurchase the stock? The number of shares that repurchased is equal to amount of debt issued, divided by price per share. So what happened to the stock price? The stock price general formula is here, right? The dividend at T1 and RS minus G. And we can say D1 can be calculated by EPS, earnings per share, multiply dividend payout ratio, and denominator is same. So EPS can be calculated by net income over number of shares, right? So when firm announce recapitalization, it affects these factors, number of shares, and one more, RS, required rate of return on stock. We will learn Hamada equation regarding this. So now let's run with example. This slide shows the cost of debt at different debt ratio. So we assume total asset is $200. As you can see, the RD, these numbers are projected number. How can you know? Like a matching method, the same industry, find similar debt ratio or bond rating, and then get this RD, the projected RD. And bond rating, this letters comes from the credit rating agency, right? Like S&P or Moody's. So in this table, as you can see, when firm borrow more money, their credit rating goes down and RD also goes up, right? Why? Yeah, when firm borrow more money, default risk goes up, right? So their bond rating goes down and the cost of debt increase. And now we want to calculate debt to asset ratio and debt to equity ratio. As I mentioned before, there are balance sheet, total asset. This is debt, equity, right? So in this case, 0, and debt to asset. So you input this number. You get same ratio, right? And debt to equity. How about equity? You simply calculate by total asset subtract total debt, right? So this amount of money subtract total debt, and repeat this process, you get these numbers. Right? There's one more question regarding this table. Why do bond rating and cost of debt depends upon amount of debt borrowed? As firm borrow more money, the firm increase its what types of risk? Default risk, right? Causing the firm's cost of debt to increase. Yeah, that is conclusion regarding this question. Now we are going to analyze the recapitalization at various debt levels. So this case, when debt is 0, right? And net income here, right? I already copied the equation, and it can be calculated using this equation, right? Yeah, we already learned how to get the net income, right? The EBIT, subtract the interest, and multiply the tax rate, and then we get net income, right? So just input the numbers here. The EBIT is here, right? So write down the numbers. How about RD and D? Yeah, there's no debt, so we input 0, right? Tax rate is 40%, and denominator is here, and then you get this number. Now firm issue $250,000 debt, right? So in this case, firm announced the recapitalization and new debt issued, and that proceeds are used to repurchase the stock, right? So that is proceed. And this number comes from here, right? Price per share is $25. So this is the price per share. Then we can conclude firm repurchase 10,000 stocks. So when firm repurchase the stock, what happened to EPS? number of shares change, right? The denominator goes down, right? Because we repurchase the stocks. Also, the net income change. In this case, RD multiply D, this part goes up, right? This part goes down. So this firm shares outstanding is 80,000. So we can write down 80,000, subtract this number, right? And numerator is EBIT. EBIT is here, 400,000. RD is 8%, right here. The debt amount is here. And multiply tax rate. Tax rate is here. Then finally you get this amount of EPS. And repeat this process. When debt is 500,000, the EPS is this amount. And debt increased to 750,000, and debt increased $100, right? You get this amount of EPS. Now we are going to calculate the stock price, the P0. And for simplicity, we assume the G, this G, dividend growth rate, is 0. There's no growth. And one more assumption is dividend payout ratio also equal to 1. It means what? Does not reinvest anything, all the earnings pay out with dividend. So finally we get this equation. When dividend payout ratio equal to 1, EPS is the same to DPS. So we get current stock price can be calculated by DPS over RS. So to find the expected stock price, we must find the appropriate RS at each of the debt levels discussed. RS we call the required rate of return, right? How can you calculate this? Using CAPM, right? Capital Asset Pricing Model. So in the CAPM, RS is RRF, risk-free rate, and market risk premium multiply beta, right? I rewrite the equation. To calculate the required rate of return on stock, we should know the beta, right? How can you know? There are some equations regarding this, Hamada equation. The Hamada equation quantifies the increased cost of equity due to financial leverage. The financial leverage, it means new debt issue, right? So when firm issue new debt, it increase what? Increase cost of equity. Why? As we run this graph, as firm borrow more money, the firm increase its default risk, causing the firm's cost of debt to increase. Not only cost of debt, but also cost of equity also increase. As an investor perspective, default risk increase, it means investor require more return about this, right? So stockholders require higher return. The cost of equity increase must be the beta increase. So we need to estimate the new cost of equity. So Hamada equation is about how to calculate the new cost of equity when firm use more debt. This is Hamada equation. This is level we don't prove the Hamada equation. It will be given in the exam, so you don't have to remember this equation. Just try to understand the story. So the BL means the levered beta, and BU, U means unlevered beta, and T, it means what? Tax rate. And this part, not debt to asset, this part is debt to equity, right? So here is example. Suppose the risk-free rate and the market risk premium is 6%. The unlevered beta of firm is only 1. The unlevered beta means what? When firm does not have any initial debt, the firm's beta is 1. And we were previously told that total assets were $200, right? So now we are going to calculate the levered beta, right? So from the Hamada equation, the BU unlevered beta 1 plus 1 minus T, debt to equity ratio, right? So input the numbers. Unlevered beta is only 1. Tax rate is 40%. And debt amount is here, right? How about equity? Yeah, total asset is this amount. So subtract the debt. Total equity is right. So finally you get the levered beta, that is 1.0857, and then calculate RS using CAPM, right? Yeah, this is Hamada equation, and this is CAPM, capital asset pricing model, and RRF 6%, right? So 6%, and market risk premium also 6%, and levered beta is here, right? Multiply 1.0857, then get new cost of equity. This slide shows the table for calculating levered betas and cost of equity. So at the previous example, we calculated this, right? And repeat this process, we get these numbers, right? How can you get these numbers? Yeah, just change debt amount, right? This and here, right? When debt change, total equity also change, and get the levered beta, and input here, get new cost of equity. So I already calculated the numbers So when you calculate this equation, you get level beta is 1.2, RS is 13.2%, and this is here. So finally, we all calculate the level betas and cost of equity. We can calculate the stock price, right? So we assume DPS is the same with EPS, right? Because when dividend payout ratio equal to 1, right? So we already calculate EPS here, right? Yeah, when that is equal to 0, EPS is 3. That increased to 215,000. EPS is 3.26. So we can input the numbers. Then where this RS comes from? Do you remember? Yeah, at the previous slide we calculate using Hamada equation and CAPM, right? So using Hamada equation and CAPM. Yeah, Hamada is one person's name. Yeah, he is Japanese American professor, the researcher. He invented this equation, so we call that Hamada equation. I'd like to tell you one more thing about Hamada equation. In reality, most of firms are already levered, right? So in this case, firm issue more debt. How can you calculate a new levered beta? So if the firm is currently levered, it means firm has initial debt. How do we have to do first? The first we use the observed beta. How can you calculate the observed beta? Yeah, there are 3 steps, right? Do you remember? At the risk and rate return of part, we draw a graph, right? The x-axis is market return and y-axis is company's return. And firstly, we plot the data point, market return and company's return. For example, like this. Then secondly, draw a regression line. And the slope means what? The slope means the beta, right? Then calculate the unlevered beta from levered beta. So we say this process as unraveling. So using Hamada equation, BL, this level beta we already calculated using this, right? And calculate BU 1 plus 1 minus T debt to equity ratio. We also call the unraveling process as to extract the financial risk. And then secondly, you can calculate, find the new rebel beta, right? So BU to new BL, we can say this as re-rebelled. It means putting the financial risk. So new rebelled beta can be calculated unrebelled new debt to equity ratio. So we can highlight the BU is here, right? Yeah. The first step, we calculate unlevered beta. We extract all the financial risk, and finally we get new levered beta with new financial risk, right? So maybe this older levered beta has another debt to equity ratio, right? But now we get new levered beta with a new debt to equity ratio. And finally, find new cost of equity using what? Using CAPM. So when POM is currently levered, you can calculate new levered beta and new cost of equity using this process. So move back this slide. Now you want to calculate P0, the current stock price, right? We already get the DPS and cost of equity. The P0 can be determined by this equation, right? P0 is DPS, dividend per share, to cost of equity. So we can write this is DPS over cost of stock. So you can calculate these two, and finally you get the stock price. I already calculated. So what is the company's optimal capital structure? Yeah, as we learned before, the objective of POM is maximize POM value. It also means maximize the stock price, right? In this case, when debt is this amount, the stock price is highest number, right? So we can draw a graph like this. This is debt ratio. This is POM value. And we can say this is stock price, right? And the number and input, then get this graph. This point is here, right? 25%. Yeah, this number. So for example, POM is in this point. To maximize the POM value, POM try to issue more debt, right? So issue bonds. It means buy back stock. Increase debt ratio. What about this point? To maximize POM value, they should reduce the debt ratio, right? So in this case, we can say issue stock buyback bond decrease debt ratio. So far we run the maximize pump value and maximize stock price, that is optimal capital structure, right? And we can also say that is minimize the WACC. Why? Do you remember at the corporate value model, the pump value is determined by the free cash flow and denominator is WACC, right? Power of t, sigma t equal to 1, infinite. So when you minimize this WACC, this part goes down, right? And pump value can be increased, right? So now we are going to find where is the WACC is minimized. So now you want to calculate this and this, right? And this number we already calculated at the previous slide here, right? So the first is there's no debt, so 0%. 0%, and second one it is 4.8%, and this number comes from 8% multiply 1 point tax rate, and repeat this process, you get these numbers. How can you calculate the WACC? The WACC equation is here, right? The WACC can be calculated by rate of debt, cost of debt, and there is some tax deduction, right? And rate of common stock, cost of common stock. So we already know each variable, right? So rate of debt is what? 0, right? And RD and 1 minus T is here. And rate of stock is here. This is WS. This is WD. So you can input all the numbers and finally get this result, right? And repeat this process, you get these numbers. So where is the cost minimized? Where is the WACC is minimized? Here, right? And it is same with this result, right? Because it has same meaning. The maximize pump value means maximize stock price, and it means minimize the WACC. Using this table, you can draw a graph, right? So if you draw a graph, you get this rate of debt, y-axis is weighted average cost of capital. As you can see, when PUM has 0 debt, it means PUM has 100% of equity, right? This number. In this case, WACC is 12%, but after that, PUM use some debt, the equity to asset ratio decrease, right? And weighted average cost of capital also decrease. And it decreased to some optimal point, and then it increased, right? So we get the U-shaped graph. Right? This is 25% here, right? Why this happen? They're using the WACC equation. WDRD 1 minus T WS RS. In this case, we assume WS is 1 minus WD, right? So we can write and most of case the number of RD, the cost of debt is small number than cost of equity. So the first part here, their equity ratio goes down, right? So the cost reduced from here to here, right? And after the optimal point, cost increase, right? Why? The RS increase itself, and one more thing, RD and 1 minus T also increase. What does it mean? Yeah, default risk also increase. So firm's weighted average cost of capital increase after optimal point. So far we run the optimal capital structure, and it means optimal debt proportion, which maximize the firm value and which maximize the stock price and which minimize the WACC, right? Next lecture we will learn some theory about the optimal capital structure that calls the MM theory, Modigliani and Miller. Thank you.